Quick disclaimer, this is an AI voice, which is not going to be perfect. There is a transcript in the description as well as subtitles for you to read along with. Credit has a major role in the economy, which is mostly provided by banks, both having an impact on the economy. A bank is a financial institution that channels funds from savers to borrowers. One role of banks is to channel savings towards investment by lending out deposited funds to businesses and individuals for productive activities, which stimulates economic growth, job creation, and overall development. Another role of banks is to provide credit by lending money to borrowers, which fuels consumer spending, business expansion, and investment, thereby driving economic growth and stability. Another role of banks is to set interest rates on loans and deposits, which is the cost of borrowing money or the return on savings. Doing this influences borrowing, saving, and spending behaviors, which shapes economic growth, inflation, and financial stability. Another role of banks is to require collateral, which is an asset that can be used to repay if the borrower has insufficient funds. Doing this reduces their risk, which ensures more secure lending practices and helps maintain financial stability in the economy. Risk is the likelihood that a particular outcome will occur, whereas liability is the responsibility for the financial debts of a business. There are two types of liability, which are unlimited liability and limited liability. Unlimited liability means the owner is responsible for all the business's debts and must pay off these debts using their own money if the business cannot afford it. This means that the owner is personally exposed to the failure of the business, as they are personally responsible for all debts and they are legally liable for the business. Because of this, the owner is less likely to take risks, which limits the growth of the business. However, unlimited liability businesses will often find it easier to raise finance, as they are seen as more credible because the owner needs to be more cautious. Limited liability means the business is owned by shareholders who can only lose the money that they've invested into the business. This means that the financial liability is limited to the amount that has been invested, so owners can take greater risk, which would lead to greater reward. This also means that the owners are protected against legal claims. However, in order to receive finance from a bank, smaller limited companies may need a shareholder to be a guarantor and take on limited liability, as banks may be cautious to lend to a company whose shareholders don't want to take personal risk. There are two types of limited liability companies, which are private limited companies and public limited companies. With both types, multiple people can buy shares in the company and become a shareholder. With a private limited company, people must be invited to buy shares, whereas with a public limited company, any member of the public is able to buy a share of the company. Credit is a financial arrangement that allows individuals or businesses to borrow money or receive goods and services with the promise to repay later, often with interest, whereas finance is the area of managing and investing money. Each has many types and sources, as well as many roles and impacts in the economy. There are three types of credit, including loans, overdrafts, and trade credit. Each of these will come from a different source of credit, including banks and other firms. Loans are a fixed amount of money that is borrowed from a bank and is repaid with interest over a set period of time. Loans offer a fast and straightforward way to borrow large sums with a structured repayment plan without affecting control or claiming a share of the company's profits. However, small business owners are personally liable for loans, which accrue interest, and failing to repay them can lead to poor credit ratings or bankruptcy, often requiring collateral. An overdraft is the money drawn out of a bank account that the individual or business does not actually have. Overdrafts are quick to arrange and provide a smaller term solution. However, they are only suitable for small amounts and charge interest if they are not paid back on time. Trade credit is an item that is bought from another firm but is paid for at a later date. Trade credit gives the business more cash to use in the immediate future. However, trade credit can only be used for specific purchases, with bills often due within 30 to 90 days, and the failure to pay may end the relationship and halt future supplies. There are many other types of finance, including owner's capital, retained profit, sale of assets, individual investors, online collaborative funding, venture capital, share capital, and leasing. Owner's capital is the money put into the business by the owner. Owner's capital means that there is no need to repay or pay interest. However, using owner's capital is risky, may be insufficient, and represents money that could have been invested elsewhere. Retained profit is the money kept in the business. Retained profit provides fast access to funds without the need for repayment or interest. However, this may be limited, could have been invested elsewhere, and can lead to shareholder dissatisfaction if dividends are reduced. Sales of assets means items that the business owns are sold. Selling assets allows a business to utilize existing funds and is effective for disposing of underused assets. However, this requires the business to have valuable items to sell and risks disposing of something that might later be needed. Individual investors provide funds to a business in exchange for equity or a share of the company. This means that the business can access capital without having to repay immediately or pay interest. However, individual investors may require a stake in the business, which potentially dilutes ownership and expect a return on their investment, which can be costly or lead to disagreements on business decisions. Online collaborative funding involves raising money for a business through contributions or donations from a large number of people using online platforms. Online collaborative funding means access to a broad pool of potential investors and often doesn't require a payment or interest. However, it may involve significant time and effort to manage campaigns, and there is no guarantee of reaching the funding goal, which could result in the business not receiving the finance needed. Venture capital is where venture capitalists invest in a small, risky business for a small proportion of the company's share. Venture capital provides an immediate cash injection and valuable experience without the obligation to repay. However, doing this is risky for the investor, can reduce the owner's profits, and may involve the investor seeking some level of control. Share capital is where a share in the business is sold to an individual or business. Share capital provides an immediate cash injection without the need for repayment or interest, allows raising large sums, and can bring valuable knowledge and experience to the boardroom. However, doing this may require paying dividends to shareholders who will also have some influence over business decisions. Leasing is a long-term rental agreement with a supplier, which allows the business to use the equipment without having to buy it outright. Leasing spreads out the cost, eliminates the need for a lump sum, and often includes maintenance and updates. However, doing this can be more expensive, requires regular monthly payments, and doesn't result in ownership of the asset. The role of credit in the economy is to help with economic growth by allowing individuals and businesses to borrow money for investment and consumption, which boosts spending and expansion. It also helps manage cash flow by providing short-term financing options, which can stabilize the economy. The impact of credit in the economy is that it drives economic growth by enabling increased spending and investment, leading to business expansion and job creation. However, excessive credit can lead to financial instability and higher levels of debt, potentially contributing to economic downturns and financial crises. Thank you for watching this video on the role of credit in the economy. I'll see you in the next lesson.